This accounting mini lecture video provides a summary of adjusting entries. Now, the first thing that I would like to clarify, oftentimes when people hear the term adjusting entry, the first thing that they think is that it's an entry correcting a mistake. In most cases, that is not the case. Now, it's certainly possible that an adjusting entry could correct a previous error, but in most cases, it's not. In most cases, an adjusting entry is simply an entry that we're going to record to ensure that our revenues, expenses, assets, and liabilities are properly stated at the end of the period in accordance with GAAP-based accrual accounting. So what we're really going to be accounting for is accrual and deferrals. On this screen, we see a summary of the 4 basic types of adjusting entries. And we'll actually look at each of these types in a little bit more detail in some separate videos. But this is just a summary of the 4 types of adjusting entries. We have prepaid expenses. These are often called deferred expenses. We have unearned revenues, which is a liability. These are our deferred revenues. And then we have our accrued expenses and our accrued revenues. On this slide, we see a quick summary of how each of these entries is going to impact our financial statement accounts, okay? For prepaid expenses, okay, if we did not adjust for our prepaid expenses, we would have an overstatement in the asset account and an understatement in expenses, which is going to lead to our equity being overstated because remember, our net income eventually flows into equity through retained earnings. So how do we adjust a prepaid expense account? We debit the expense and we credit the asset. Remember, prepaid expenses are carried as assets. For example, it might be called prepaid insurance or prepaid advertising, but it's going to be an asset on the balance sheet. Okay? Unearned revenues. Okay? Unearned revenues are basically the work or goods, services that we owe to our customers. We've received the money in advance, but we still owe the customer. In order to record an adjusting entry for unearned revenues, we debit the liability account to reduce it, and we credit revenue basically for the portion of the revenue that we've earned. If we failed to make this adjustment, our liabilities would be overstated. Our revenues would also be understated, which would lead to an understatement in equity. Okay? Accrued expenses. These are basically expenses that we have incurred but we have not yet paid. To record an accrued expense, we are going to debit expense and credit a liability account, such as accounts payable. If we failed to do this, we would have an understatement in liabilities. Our expenses would be understated, which would lead to a higher net income and an overstated equity. Accrued revenues. These are revenues that we have earned, but we have not yet received the cash. Okay? To accrue revenues, we would debit an asset account, normally accounts receivable. We would debit accounts receivable and we would credit revenue. If we failed to do that, our assets would be understated. Our revenue would also be understated, leading to a lower net income and an understatement of equity. So when we look at the potential impact of failing to record these monthly adjustments, I think it's a little bit easier to understand the importance of making these entries at the end of each accounting period. And again, there will be some additional videos that will look at each adjustment account in a little bit more detail. But thank you for taking the time to watch this video summarizing adjusting entries.